Dow 52,000, S&P crossing 7,440. Nasdaq 100 pushing past 29,770. You are waking up to a just a front page summit photo on the screens this morning. But if you look at the overnight session, the implied open is painting a wildly different picture.
Right, because the headlines are flashing this undeniable victory, right? Alphabet officially replaces Verizon in the Dow. We are wrapping up the first half of the year, and retail sentiment is just, it's euphoric.
Totally euphoric.
Yeah, but you look at the pre-market volume and the institutional strategy briefs, and the atmospheric conditions are shifting violently right under our feet.
Exactly. So it is Tuesday, June 30th, 2026, and our mission for this deep dive is to cut right through that celebratory noise. We've got a massive stack of institutional alerts and overnight flow data to figure out what is really happening under the hood.
Because you need to know if this is the ultimate Q3 breakout, or, just a meticulously set macro trap.
Right. Okay, let's unpack this. Yesterday's surge was driven by what?
It was almost entirely geopolitical relief. We saw U.S.-Iran tensions in the Strait of Hormuz finally ease up, hostilities halted, peace talks are actively resuming in Doha today, and that immediate removal of global tail risk just pulled Brent crude down below $73 a barrel.
Which is huge for equity.
Oh, massive. When you lift a geopolitical weight like that and energy drops, institutional capital just rushes back in. That's what drove the S&P 500 up 1.12% to 7,440.43. And it caused the Nasdaq 100 to absolutely pop 2.25% to 29,774.75.
But if I'm visualizing the mechanics of that rally, it's kind of like a rubber band.
Rubber band.
Yeah, like the market was stretched incredibly tight by all that geopolitical anxiety,
Right, yeah.
and looming threats to the global oil supply.
Right.
So the Doha peace talks happened, and it doesn't mean the global economy is fundamentally stronger today. It just means somebody let go of the rubber band. It snapped back to its normal resting state.
That is exactly it.
But a snap backward shouldn't be mistaken for, actual forward momentum, especially since we have a massive wall of U.S. macro data hitting at exactly 10:00 a.m. Eastern.
Right. The easy money from that geopolitical relief bounce is already gone. The algorithmic traders and the fast money extracted it yesterday. So now the rubber band is slack, and we have to face actual economic gravity.
May JOLTS job openings, the June Chicago PMI, consumer confidence. I mean, do these really carry enough weight to derail a $52,000 hour?
Well, the real risk here is how the market interprets that data in a low-volume holiday week.
Oh, right, heading into the 4th of July.
Exactly. Institutional liquidity is already thinning out. And this is where that micro trap becomes incredibly dangerous. You have to watch the line in the sand support levels today. For the S&P 500, that is 7,481. For the Nasdaq, it's 29,820.
Wait, if the Nasdaq closed around 29,774, we are already flirting with that danger zone. Are institutions seriously going to dump tech and trigger a sell-off just over like a slight shift in job openings?
They absolutely will. It all comes down to the mechanics of a liquidity sweep. Think about the thousands of retail traders who chased yesterday's rally.
Right, they all put in stop-loss orders just below the current price to protect themselves.
Exactly. And institutions know exactly where those stop losses are clustered. Right around that 7,481 mark on the S&P and 29,820 on the Nasdaq. So if the JOLTS data at 10:00 a.m. comes in hot, showing a tight labor market that keeps rates high, the big algorithmic players will literally just step away.
They just pull their bids.
Yep. They'll let the floor drop out just enough to trigger that avalanche of retail stop losses.
So they basically force a massive wave of selling. The retail guys get cashed out automatically at a loss, the price plummets, and then the institutions just...
They sweep in at the bottom.
Wow.
Yep.
They just buy up all that liquidity at a massive discount.
It is a classic holiday week maneuver. The volume is low enough that they can easily manipulate those support levels and leave the latecomers holding the bag.
Okay, well, here's where it gets really interesting, because the real risk here is the specific sector where these retail buyers are clustered. I'm looking at the pre-market right now, and tech and semiconductors are showing immense strength.
Yeah.
Nasdaq futures are leading up 0.12%. The SMH semiconductor ETF bounced 3.33% yesterday. The retail narrative is that AI data center demand is this, like, rock-solid floor, but the strategy notes we're reading are aggressively bearish on tech's long-term setup. They're calling it a persistent macro headwind masquerading as a temporary relief trade.
Because what's fascinating here is the severe tension between the very real demand for AI and the cold, hard reality of global bond math. You have to look at two stealth headwinds. First, the U.S. dollar index, the DXY.
Which is sitting at 101.24 this morning. It's up more than 2% just in June.
Right. And people hear strong dollar and think it's great.
Good for buying stuff abroad, sure.
Yeah, but for multinational tech giants, it's a massive anchor. Apple, Microsoft, Alphabet, they generate a huge chunk of revenue overseas. So when Microsoft sells Azure cloud services in Europe, they get paid in euros.
And if the dollar is surging, when they convert those euros back to dollars for their earnings report, the revenue literally shrinks.
Exactly. It's a stealth margin compression happening entirely on the foreign exchange desk. The dollar acts as a literal currency tax on their global success.
Man! And that currency tax is just compounding the second headwind, which is the 10-year Treasury yield. It is incredibly sticky at 4.37% this morning.
Up from 3.96% back in February.
Right. Driven by the Federal Reserve's pivot under nominee Kevin Warsh. They've stripped away all that easy money language. We are now pricing in a hawkish, higher for longer reality. And just to be clear for everyone listening, we're looking at this purely through an objective mechanical lens. This isn't political. It's just how the Warsh Fed's policy physically dictates asset prices.
Absolutely. The objective reality is that a 4.37% yield on a risk-free government bond fundamentally breaks the valuation math for high-growth tech companies. The technical term is multiple compression.
Okay, let's put a visual to multiple compression. If you think of the risk-free interest rate like gravity on a planet, right?
I love this analogy.
If gravity is super light, like a 1% yield environment, speculative future earnings, like the profits AI promises 10 years from now, they can jump incredibly high. Investors will pay a massive premium today because cash is cheap.
Right.
But when the Fed turns up gravity to a 4.37% yield, those future cash flows suddenly get exponentially heavier. The present value of money you might make in 2035 shrinks dramatically when you can just grab a guaranteed 4.37% from the U.S. government today.
It shrinks dramatically. And it's not just theoretical valuation models either. AI infrastructure is incredibly capital intensive right now.
Yeah, tens of billions on data centers.
Exactly, and energy grids. And a huge portion of that CapEx is debt funded. So when interest rates park in a higher for longer regime, the immediate cost of servicing that debt skyrockets. So you've got revenue shrinking from currency conversion, future valuations compressing from high yields, and immediate operating costs rising from expensive debt.
The AI hype is real, the tech is real, but if the foundational math doesn't work, the stock simply can't sustain a limitless climb.
It can't.
Which brings us to the terrifying scenario in these strategy briefs, the ultimate pain trade.
The pain trade. So the threshold every institutional risk desk is watching this morning is the 10-year yield hitting 4.50%.
Right.
If that jolty says labor report today comes in hot and forces the bond market to price in fewer Fed rate cuts, we could see yields spike right to that level.
And the briefs show a massive divergence here. Retail investors are treating this like it's 1999. They are aggressively buying every single dip in the Magnificent Seven and semiconductors, treating any pullback as a guaranteed opportunity.
But institutions, they operate on strict risk mandates. If the 10-year yield crosses 4.50, portfolio managers are not going to hold incredibly expensive rate-sensitive AI hyperscalers.
And they aren't going to just sit in cash either.
No, they violently rotate their capital.
So what does this all mean? They move money out of crowded growth trades and flood it into value sectors.
Exactly. Financials, industrials, small caps. Sectors that actually correlate positively with a hot economy and higher rates. If we connect this to the bigger picture, it exposes the brutal reality for everyday investors. They're positioning themselves to be the bag holders.
Because they're aggressively buying these extensive growth narratives right when the smart money is quietly slipping out the back door.
Using that retail enthusiasm as highly liquid exit liquidity, yeah. Institutions have zero loyalty to AI. Their only loyalty is to yield.
It's a harsh reality check. All right, so we've broken down the macro tectonic plates, the surging dollar, the 10-year yields gravity, sector rotation. Let's look at how these specific forces are driving the micro movers in the pre-market right now.
Let's do it.
We'll start with AST Space Mobile, ticker ASTS. Massive gap and go, up 21% yesterday to close at 86.77, and it is holding strong in the pre-market.
Yeah, ASTS is the perfect example of how pure, verifiable execution can just completely detach a stock from those macro headwinds.
Because they actually delivered hardware.
Exactly. They beam broadband directly from space to unmodified smartphones. And the catalyst for this 21% explosion is confirmation that their BlueBird 8, 9, and 10 satellites are fully operational in orbit.
Plus, they paired that with a massive $1 billion joint venture with Japan's Rakuten Group. So, in a market that's heavily discounting future promises, ASTS delivered tangible hardware and $1 billion in international backing.
The market will always reward execution that defies macro gravity. Now, on the flip side, look at a company undergoing structural mechanical changes. Honeywell is fascinating today.
The conglomerate breakup is officially done.
Yep. Honeywell Aerospace is now trading completely on its own under the new ticker HONA. Meanwhile, the legacy automation parent company keeps the old ticker HON, but they executed a 1-for-2 reverse stock split overnight.
And a reverse split doesn't change the fundamental market cap, right? It just halves the share count and doubles the price.
Right, but it's a critical optical maneuver for institutional flow. If you spin off a massive division like aerospace, the parent company's share price would artificially plunge. By doing the reverse split, Honeywell keeps their share price high enough to satisfy the strict price mandates of massive mutual funds and pensions.
To prevent forced selling.
Exactly.
And the breakup is triggering a massive forced B-waring ripple effect elsewhere. MSCI Inc. is gapping up an incredible 9.66% today. Because HNA is now a standalone giant, MSCI is officially adding it to its global standard and large cap indexes this morning.
So every passive index fund that tracks MSCI is mechanically forced to buy HON today. It's guaranteed volume.
Amazing. Now let's talk about the companies falling victim to the exact consumer vulnerabilities that macro data is warning us about. Yum. Brands, ticker YUM, gapping down 3.59%.
This one is rough.
They are executing a massive portfolio restructuring, selling the Pizza Hut brand for $2.7 billion to private equity and Yum China, which, on paper, a multi-billion-dollar cash influx sounds incredibly bullish. Plus, they're launching a $4 billion buyback.
In a vacuum, a $4 billion buyback sends that stock soaring.
Right.
But we aren't in a vacuum. We are in a hypersensitive macro environment. The market is violently punishing them today because their major European franchisee, Collins Foods, issued incredibly weak forward guidance.
So the market looks at weak European consumer data and decides the structural drag on pizza and chicken sales totally outweighs the financial engineering of a buyback.
Exactly. That buyback might provide a floor later around, say, the 165 level, but today, the reality of a weakening global consumer wins the tug of war.
Which brings us to our final mover, McCormick & Company, ticker MKC, down 3.23% this morning. And if you want a masterclass in the exact mechanics of the pain trade we discussed, this is it.
Textbook sell the news, liquidity exit.
Right. So an everyday retail trader opens the McCormick earnings release this morning and sees a company firing on all cylinders. Sales up 16.7%. Strong EPS beat at 80 cents. They even raised their forward outlook. Every conventional retail metric says hit the buy button.
But look at the mechanics of how large funds like AMI Asset Management trade this. They build their positions in the weeks leading up to the report, riding the anticipation up. When the report drops and it's universally positive, retail rushes in.
And the institutions use that sudden surge in demand to exit.
Exactly. If a massive fund tries to dump millions of shares on a quiet Tuesday, the stock crashes under their own weight. But if they sell into a wave of retail buying, they unload their entire position at a premium without crashing the bid.
They quietly extract their capital, lock in gains, and rotate into the next sector. The underlying spice business is doing great, but the stock drops 3% because big money is just actively draining liquidity from the asset. Retail buys the confetti, institutions slip out the back.
It's the exact micro version of the rotation out of AI we talked about earlier.
So pulling this all together, the Dow breaking 52,000 is an undeniably fantastic headline. But to be a well-informed, active trader today, you have to look past the milestone. You've got to monitor that 10-year yield creeping toward 4.5%. Understand that yesterday's tech surge was geopolitical relief, not organic momentum, and watch out for those algorithmic liquidity sweeps.
Read the atmospheric conditions, not just the thermometer.
Which actually brings me to a final underlying shift. We mentioned MSCI gapping up nearly 10% today for adding HNI to their indexes. But buried in their press release is another massive catalyst. MSCI just announced they are acquiring First Street.
Oh, this is huge. First Street is a physical climate risk modeler.
Right.
And this acquisition is a fundamental paradigm shift in how global finance defines risk. MSCI creates the math that governs trillions in passive funds. By bringing First Street in-house, they're signaling that asset pricing won't just rely on PE ratios or the Fed anymore.
They're building the infrastructure to integrate real-time climate calculations, like flood zone probabilities, extreme heat vulnerabilities, directly into the daily valuation of an asset.
We are rapidly approaching a world where a global index could be automatically reweighted based on the trajectory of a Category 5 hurricane in the Atlantic. Institutions are literally building algorithms to hedge against the atmosphere.
The weather isn't just a metaphor for market conditions anymore. Very soon, real-time climate data will actively dictate the flow of trillions of dollars. The ultimate atmospheric condition. Definitely something to heavily mull over as you watch the pre-market volume translate into the opening bell today. Good luck out there.